Everyone, and welcome to Vlog 3 of Lake Effect Investments. It's been about a week or so since I did the previous vlog, and not a whole lot has happened except for the Jerome Powell speech at Jackson Hole. And as expected, a bit of a relief for the markets that um, Powell's statement about that the time has come to make a change in policy, which really rackets up the expectations for a September rate cut, most likely expected to be a moderated 25 basis points. And kind of my own personal unilateral outlook is that we'll see probably another 25 basis points before the end of the year and likely 50 to 75 basis points in the first quarter of 2025. But everything depends on how economic factors come out and probably a whole bunch of other market factors play out between now and then. And as we're coming into a policy shift, so this kind of signals that the inflation objective of the higher rate regime have more or less been achieved. So we have lower inflation, slightly higher unemployment, which means lower demand. That kind of helps to tame inflation, and more moderated GDP growth as well. So look for a sort of a renewed focus on perhaps some other economic factors. The Fed can cut interest rates because it probably doesn't want unemployment and economic activity to get completely out of control. But it is absolutely no guarantee that it is going to spur economic activity and it's going to be able to tame unemployment. A lot depends on a bunch of other economic factors. Primarily, I would think consumer sentiment and retail sales is typically a big one that plays out, especially seasonally during this part of the year as the major activity and earnings seasons for retailers comes into play, and then that kind of also is a signal for consumer confidence too. So policy is done, but I would think that other factors such as consumer confidence, particularly durable goods orders, jobless claims, unemployment, GDP growth, and stuff, bunch of stuff coming out this week in these areas. I think these will be more key to look at going forward and maybe how markets choose to react. So, despite lowering interest rates, if we do see unemployment spike and if we do see a bigger contraction in GDP growth, the market can't take a very negative view of that. And the market is at elevated levels. You look at the Nasdaq. You hear record broken, like a broken record in the news all the time with the market. So the sell-off risk is always going to be there. And if we look at Nvidia as well, uh, it's a Max 7 stock, and there's been a lot of media narratives that there's definitely overspend in AI, um, and its chips are the favorite market product right now. But other Max 7 companies like Facebook, Apple, Amazon, etc., are overspending um, during this phase of the AI build out. But that is likely not going to last, right? At some point, they're going to have to rationalize it and put some P&L frameworks around their mega spends in AI, and they'll likely cause a retraction. But exactly when that happens, we don't know. Could be a 1Q25 thing, and maybe that'll cause a retraction and a sell-off or a correction or something. But hopefully, with our portfolio that we're looking at, we'll be able to sidestep that because we're looking at a very different animal over here with these low cap, early life, um, sort of like disruptive industry stocks, which are pretty suppressed, and they're kind of on a very different rate curve that we've looked at before. That's kind of our stock rate curve, so it's kind of opposite to the Nasdaq, and that's kind of what the play is over here. Maybe when a sell-off like that comes, we get a renewed focus in these stocks. They become more market darlings than they are now, which is maybe kind of more in the ignore bucket. But there was a media frenzy around a rotation to small caps back in the mid-July timeframe. and not sure exactly what came of that. I mean, when they talk small caps, they're not talking our particular portfolio, but something kind of more along the curve, more mature than these early life slash startup companies. But anyways, something along those lines can happen, and that'd be definitely be good for us. So let's do a quick price check on our portfolio and then move on. Um, Sitting okay, sitting pretty, but it's only 2 weeks old, so it doesn't really mean much. Can swing wildly in either direction. Hopefully, we've timed the bottom, with some of these stocks. Here's the acquisition prices, which you can check from VLOG1. I think it was a couple of weeks ago. So yeah, hopefully we have timed the bottom there, but only time will tell. Okay, so since the markets are kind of waiting around, waiting for something to happen, I think it's a good time to zoom in and kind of take a look at the EV sector segment. And I'd say that on a sector level, on a segment level, this is probably the one that I feel the most bullish about. And despite its current uncertainties and anxieties, especially in the market, and basically the backstory on that is that the spectacular Tesla story and the subsequent market break-in, which means that the market has been established. Tesla as a company is valued now at close to 700 billion. Has a fully fledged, mature, high margin based P&L. We can kind of take a look at that later. And it's broken into the market. So EVs now command a 7 to 8% market share. Some say even possibly a little bit higher. And it's even higher in Europe and China, right? So if I ask AI, well, what's going on in Europe? It's telling me something like 14% for battery electric vehicles. And if I switch that over to China, right, it's telling me something even higher. And honestly, these numbers are a little bit hard to come to terms with. This seem a little inflated. But even if you moderate it down to 30% or even, you know, 10%, 11% in Europe, it's still spectacular and it still is a full-fledged market break-in. Right, and that, in my view, points to further growth. Despite the current uncertainties, um, just to illustrate that a little bit more, um, if you take a look at this visual over here, this shows you the EV sales story in the US over the last 7, 8 years or so. And we have 1.6 million units sold in the US. Pretty good concentration in California over there. But yeah, that's that is a total market break-in, and we have critical levels achieved, I think, in terms of adoption of the technology, acceptability of the technology, and we're definitely taking a breather right now because these kind of growth levels are very difficult to sustain, and it's going to be impossible to sustain that. Um, so likely some moderation, and then I think some re-acceleration after that as well. And it's definitely a good time for the market, for the industry to take a step back, see where they're at, and how they can continue this adoption, and how they can address some of the anxieties around EVs, which for which um, let us have a look at what Mr. Doug Demuro has to.
Which 2024 Mazda SUV is an IIHS top safety?
So I think the exaggeration of the death of electric cars is kind of crazy, and it's not really the truth. However, this is an important one. I don't think it's totally out of the realm. I don't think it's totally crazy that there is a possibility that electric cars have peaked And I don't think they're going to just free fall back down to zero, but maybe aren't going to continue to rise very significantly in the foreseeable future. And I'll tell you why. In my mind, there are three big drawbacks that electric cars are facing that they never really solved. The biggest one to me is still range. I drove cross country a couple of weeks ago. It's rare that people do that, I know. But 300 miles of range, and then you got to fill up for a couple hours, 45 minutes or an hour. I saw on Twitter, X, some guy did an EV road trip that was about as long as my recent road trip, 3,300 miles. And he said that adding electric charge added 10 hours. It saved him money and all this stuff, but it added 10 hours to his trip. And it's like, that's a day. You lost a day. Like, I drove from California to Massachusetts I can do it in 2.5 days. I took a little more time this time because I made a stop, but I've done it before in 2.5 days, California to Massachusetts. If I added 10 hours, it would be three. That's a day. That's 50% more trip. And so, like, for people who do long drives, it's not feasible. And for people even like LA to the Bay Area, or New York, Boston to DC, or down to Florida, like, the supercharger network has become quite crowded. And so range is becoming a factor again, because you can't just easily plug in and just go. You now have to actually make some choices and decisions. And I think range is an issue. Another big issue that I think electric cars are facing, which they're not really working on, is resale value. I have never seen vehicles plummet in value quite as quickly as electric cars. You can get a Model S Plaid in the $40,000 range now. You can get a Model 3 Performance in the high teens, low 20s. Porsche Taycan Turbo S's that were $180,000 new are now
Let's skip this part. Yeah, I get it.
I think, is charging infrastructure. You have a lot of people who have purchased or leased electric cars that can charge at their house. They install a charger in their garage, no problem. But for the rest of the people who don't really have that situation, who aren't easily able to just charge an electric car at home, they live in an apartment, they park on the street, they make long trips during the day and can't just come back to their house and charge, you have an infrastructure problem. And I think those three things are going to need to be addressed by electric vehicles, and they're really not. And so there's going to be a contingent of people for whom electric vehicles either aren't a smart financial choice because of the resale value, or they're not a smart lifestyle choice because of the range, or the charging infrastructure doesn't make it make sense for their lives. And so it wouldn't blow me away. I think that people are greatly exaggerating the decline of EVs, but it wouldn't blow me away if the electric car did slow down somewhat or even a lot, especially because early adopters clearly did go out and get the cars they wanted and fit into the electric vehicle mold. But many people who don't want to adopt or haven't yet may not be able, given their situation, to actually go out and get an electric car. Which
All right, so let's address those points. So those are all pretty good points by Mr. DeMuro. And we want to challenge our bullish assumptions as much as possible and see where we may be looking at this wrong. So range anxiety is the one that comes up the most. And currently, depending on who you speak with, a typical EV will do about 250 to 300 miles or so on a single charge. And, you know, cross-country trips, long road trips will lead to some anxiety around acquiring an EV. But as far as people who are looking primarily at local transportation needs around the city and the town that they live and work in, and they're able to charge at home overnight, these should be non-issues. And by the way, also with apartment complexes, more and more are installing EV chargers in their parking lots, and I've seen some over here locally as well. There definitely is a requirement to do a lot more than what's available right now, but I don't think people living in apartment complexes should be a long-term issue or a roadblock or so. So I think there's definitely opportunity over there as well. Um, if you're doing longer trips, road trips, yes, the charging stations are starting to get crowded, which again I think should be an opportunity as well to expand that network. But I think as long as you plan it, and you're able to get, if you happen to be doing a long-term trip, which I mean, honestly, I don't know what percentage of people do that, and how critical it is for them that they're able to do that and able to stop at a gas station and fill up within 3 to 4 minutes and then be on their way again. But if you can negotiate your way and you can get to a charge station and maybe have some wait time and about a 30-minute charge time and be on your ways again. I don't think that's a deal breaker for a lot of people. Also, many households in the US would be two-car households. Don't have any hard data or reporting around that. And it's always a possibility for people to own one EV car and perhaps one traditional car if they want to get around most of these anxieties. Opportunity remains, and one one point where I'm with Mr. Doug here is that at least in the media narratives, these anxieties, which are in the narrative, are not being addressed. We have no idea where the science is on this, when this is going to go up to 400 miles, and when this is going to come down to 15 minutes or 10 minutes on an average. Is that ever even going to be possible? One would think, with all the scientific progress that we come to see around us, that should be something that we would expect. But yeah, very little traction, very little media narrative around that. But anyways, given given the adoption that's taken place, given the market break-in that's happened, the 7 to 8%, the super success story, especially with Tesla, I think we are poised for growth. I think that this number is going to go up to 15, 16% um, over the next couple of years, 2 to 3 years, maybe even sooner, if these come back into trend again. I think the green economy narratives are going to be there. It feels that they're a bit subdued right now, but sensitivities do remain, and I think most seem agreeable that global warming is a thing now. It's happening. I seem to feel it. The more I talk to people, the more I get the response that yeah, it's almost kind of in your face. They feel that the planet's getting a little bit hotter, and weather patterns are getting a bit more unstable over the last 10 to 15 years or so. And there's always going to be that, well, the narrative of Mideast oil conflicts and dependency on fossil fuels and its geopolitical implications was big in the media, kind of not so big anymore. But given the current geopolitical dynamics, that could still come back and spur more renewed interest in EVs. So I'm going to go ahead and take a bullish position on this. I also did want to touch upon another important, interesting aspect of EVs, and that basically has to do with standalone startup EV companies versus legacy automakers, right? So I think this is something that's going to play out over the next few years as well. And there are kind of pros and cons on each side in terms of how much of that growth, how much of that market maturity is going to come through the standalones versus legacy automakers. So if you look at the standalone startup side, you have the great Tesla success story. So I think that's a great preamble, and I think it's reasonable to expect that there's going to be other success stories, although not likely at the same scale. But stocks like Rivian and Lucid, Polestar to some extent, are there in the news, highly focused and very highly traded hot stocks. So some of these probably will come to fruition, but I don't think it's going to quite happen at the scale that it happened with Tesla, right? And I think the ideology there is that you'll have the focus and the innovation on these products and bring them to market and making the market work and making it work for the customer, as well as solving some of those issues that Mr. Demuro was talking about, which may not happen with the same focus and innovation on the legacy side, basically because your life depends on it, right? Marketing branding might be an advantage there as well because Rivian, Tesla are pure EV companies, and we recognize them instantly as pure EV companies, whereas these guys, the Fords, the Volvos, and the BMWs of the world, where I think more of the EV electrification is happening amongst legacy automakers. But there's others too. I may be a little bit wrong about that. You do have government support and subsidies and grants, given some of those geopolitical as well as green economy concerns and ideas. On the cons, the disadvantages are that you're not scaled up, right? You don't have those critical economies of scale unless you're a Tesla, and that's going to affect your pricing. If you look at some of these Lucid cars and Rivian cars, I mean, they're priced at, I think some starting levels tend to be around 60 to 70,000. They have been improving, so they are on the curve and they're coming lower, but still pretty high for the average person, especially in an uncertain economic scenario, to go out and uh, dole out that kind of money for an electric vehicle, right? And then their path to profitability, like I've talked about before, that's still pretty uncertain as well. And then they are susceptible because of their scaling issues, um, economies of scale and things, to market economic and product shocks. And that's kind of what happened with Fisker for those of you who are following EVs. I won't harp on that too much, but that's a failed EV story right now. Small company, startup, and basically was not able to survive some bad reviews to its products, its cars, as well as some market issues and some funding issues as well. So funding, yeah, that's going to be another thing for these standalone startups, right? Because like I've talked about before, equity dilution, issuing more stock to raise funding is going to be a thing with these guys. Legacy automakers, they've got those economies of scale. They're doing the price. They're able to do the pricing even if that comes at a loss, because they've been in this industry forever and they have a huge P&L statement and a huge balance sheet, which gives them a lot of investment muscle as well, where they can use their own capital. They may not have to go out and issue more stock to raise capital or go out and get funding from banks and other areas. So they're able to do that. But then again, on the disadvantage side, their life does not currently depend on EV success. And there's always opportunity for distraction. And they tend to go back and forth with this. Like, for example, here is. So, yeah, if we look at some of these media reports here, you know, Ford's hitting the brakes hard on EVs. They're taking a $1.9 billion write down. Here's one by Toyota from much earlier on where they kind of hit the brakes on EVs as well, and I think they're kind of booting the hybrid model as the way forward. But at the same time, you have people who are doubling down on these pure EV companies like Rivian and Neo over here, billionaires, big time investors. So people do definitely see it as an opportunity as well. It's a good thing to keep an eye on. It personally plays a little heavier on me as I'm digging into these stocks to see where some of these, which one of these is going to be the next Tesla or the next half Tesla, right? Or even a quarter Tesla works very nicely. Let's just take a look at Rivian, um, because it kind of is probably the hottest, most traded stock after Tesla in the EV space, and it's at a low price point. Sure, there's stock dilution here by issuing more stocks, but if you look at the P&L here, right? So it's been about a billion a quarter, and if you add up the 4 quarters, where you're probably like close to 5 billion in sales. So that's pretty significant. That means they've got a product. They sell about 50,000 vehicles a year, and they've got it to market, and customers are buying it. But at the same time, this company is burning through a lot of cash. It's at negative 1.45. Yeah, so it's losing something like 6 billion a year in net losses. And the market's like, okay, they've got the product, they've got the revenue. That's the focus that I talked about last time with these stock profiles. And at some point, they've got to figure out their expense profile, and they got to stop overspending on research and development. Although that probably just needs to get done over the next couple of years at least, and they can bring this in line. But the market is discounting their future growth, their future potential, in a pretty significant way. And when investing into this stock, which is one stock, and it's going to be susceptible to shocks and to events, you're already valued at $14 billion, right? and which means that you're kind of want to produce about 1.5 billion to 2 billion in profit eventually around this profile, which is a pretty significant path to profitability from where they are right now. And they're probably going to have to grow their revenues twofold, threefold, fourfold or so over the next few years again. So that's why the stock has been pretty volatile. As you can see over here, the last 1 years or so, very susceptible to market news, even their own company news, sales hitting estimates, missing estimates, or beating estimates can um, swing the stock wildly. The other stock like Lucid, I don't think really worth looking at right now. Very low volumes. Still has a lot of ways to go before I think we can take it seriously. I think Rivian is definitely a focus. I'm not fully convinced that it's a great buy at these levels, especially in this environment. That can definitely change. But if it dips back down to maybe close to $10 levels, it may be worth a buy. But I'm kind of looking to sidestep that for now, given some of these concerns, and also because some growth is going to come in through the legacy automakers in the future. So let's see what happens over there, and that's kind of why I'm more vested in the charging side of things with Blink charging over here, for example, and there's other charge stocks that you can look at because I think charging infrastructure is something that really has to happen, despite you know which EV makers are going to succeed or which EV makers are going to fail. But I think the risk is a bit more mitigated if you go into a charge stock. But I know I would like to pick up a good um, EV growth potential stock, and maybe that ends up being Rivian. Maybe that ends up being something else. Maybe Polestar. But we'll see. We'll see. So I think that's a good place to wrap up for now. And maybe what we'll do is um, maybe we'll do a deep dive into Blink charging next episode, or maybe we'll look at something else. All right, take care, guys, and I'll see you next time.